So a brief introduction about myself. I'm a private asset specialist with DBS. So today we are talking about EQT Infrastructure VI. But before we get started on the infrastructure strategy, I thought it would be very good to have some background on EQT as a firm. So EQT is listed on the Stockholm Stock Exchange. It has close to 250 billion in total AUM. And EQT is ranked as the top 3 largest private equity firm globally and top 5 in terms of private infrastructure investing. For private infrastructure investing, EQT pioneered the PE approach to infrastructure investing, and the value-add infrastructure strategy was incepted 15 years ago. So DBS, we are very honored to be partnering with EQT. We are also very excited to be sharing with you this exclusive investment opportunity in EQT Infrastructure VI. So briefly on the agenda for today, we'll spend around 25 to 30 minutes on the presentation of the strategy highlights, and then to make it more interactive, the remaining time will be dedicated to Q&A. So if you have any questions, feel free to type them in the chat box. The chat box is located at the bottom right of your screen. So you just go to the bottom right, there will be a chat box located right over there. And for today's webinar, I'm very honored to have with us Lennart Blecher with us. A brief introduction on Lennart, a very seasoned investment professional. He's head of a real estate, deputy managing partner, and chairperson of EQT Exeter. Lennart is a member of the EQT Executive Committee and is the chairperson of the Infrastructure Partners Investment Committee. So this is really the brief introduction about Lennart. Lennart also helped, he was a senior banker in various financial institutions and also in ABB Group. And without further ado, I'll turn it over to Lennart. Over to you, Lennart.
Thank you very much, and thank you so much for having me here today. So I am, as you heard, Lennart Blecher, the managing partner of EQT's real asset and also the founder of EQT's infrastructure strategy. I founded that after 16 years as president of the large ABB Group's infrastructure business, and with a short stint at GE also. So we started EQT in 1994 by the Wallenberg family in Sweden, which is one of the, I would say today, Europe's most prominent industrial families. They have been around for some 150 years, and they've built companies which are well known all over the world, like ABB, Ericsson, Atlas Copco, etc. 1994, they started EQT on the private equity side. And I was asked to come to EQT 2007 to start an infrastructure strategy where we basically apply the private equity investment model, taking control over infrastructure company and then drive the transformation of those companies. Since then, we have raised some 5 funds. We're raising the 6th now. Initially only institutional capital, but now we are also turning to the private wealth market. EQT has now 30 years of history. We are about 1,700 full-time employees in 24 countries. We are one of the world's largest alternative managers with 232 billion. We are a very value-based company, and our purpose is to future-proof companies and make a positive impact. And we strive to be the most reputable investor and owner. We said from the very beginning when we founded EQT that EQT should always be more than capital. We can go to the next page, perhaps. So the whole of EQT is now built on this industrial approach from 150 years of Wallenberg heritage. This family today control more than 30% of the Swedish stock exchange. They are sitting on the board of EQT, and they provide EQT with the senior managers from all these companies you see here today. We have an industrial mindset and DNA. We use a global network of corporate leaders, and I will come back to that to help us identify strategies, investment opportunities, and so on. And doing good is very ingrained in what our whole thinking. So sustainability and ESG is on the top of our agenda. And we go to the next page, perhaps. Yeah. So over the last 15 years, EQT Infrastructure has now grown to become one of the 3-4 largest and leading infrastructure investors globally. You can say we founded the way of buying infrastructure company and transform them in a value-add approach. So when you think about EQT Infrastructure, we are not like a real estate investor where you buy a single asset. We buy companies and we develop those companies. We transform and develop those companies. And if I can give you an example, couple of examples of what we have been doing, it's easier for you to understand. So you don't think about bridges and tunnels. Think about renewable power generation companies, electric car and fleet charging companies, waste to energy companies, fiber to the home and enterprises companies, data center, digital security companies, rail, bus and ferry companies. Real companies with management, etc. And we use our industrial heritage and access to our industrial advisors to transform those companies. And we are looking for companies that provides an essential service to society. An essential service can be the provision of water, electricity, connectivity, elderly care, cancer care, whatever. And the amount or the definition of essential services develops as society develops. We have now invested some 32 billion in equity capital over the last 15 years. We are a global leader in this. We have one of the biggest teams, investment teams on the ground, namely 130 investment advisory professionals. And historically, we have delivered a return of 17% net IRRs. And it's important to understand the difference between what we are doing and if you're, for instance, investing in private equity, etc. We buy companies providing an essential services in good as well as in bad times. You need water, you need electricity, you need connectivity when the business environment is strong and when it's weak. So you have a strong downside protection with, investing in infrastructure. And here you can see also how we have grown from a 1 billion fund to now 20 billion. And the 20 billion fund is now 15 billion already committed. I think we picked up around 20% of all infrastructure commitments last year. And that's due to our historical performance, of course, where we have delivered these high net returns, despite the fact we buy defensive, future-proofed companies. If we go to the next page, we can show you the performance of the funds over the last couple of years. The first fund was 1 billion. We exited that at 2.5 times the money and 17% net IRR. The second fund is almost fully exited. We have now delivered 18% net IRR in that and 2.1 times the money. The third fund is almost fully exited. It's a 4 billion fund. It's now valued at 2.7 times the money and 22% net IRR. And now the fourth fund and the fifth fund, we are in the middle of the development and we will start exit that also this year, Fund 4. The MOIC in average has been 2.5 times the money. And not only that, the existing companies, and we have about 20 plus companies in our portfolio today, the value of those portfolio companies increased about 3 billion last year. We realized almost 2 billion of gross proceeds, and we distributed 1.5 billion to our clients last year. If we go to the next phase, we are now in a historical environment and situation when it comes to infrastructure. That is due to a couple of different reasons. One is we have historically not invested what we should in order to keep our infrastructure up to date, especially in US and Europe. In addition to that, we're entering into now the biggest industrial revolution since the beginning of industrialism, namely the energy transition, supported by the geopolitical situation in Europe and the demand to accelerating into a fossil-free society. The third reason is digitalization of society needs to accelerate. We cannot develop the artificial intelligence without building out a substantial amount of fiber optics and data center. The need for data center is exploding right now. And the public sector cannot absorb all these investments we need to do now. So clean energy versus fossil fuel. Until 2015, the investment in fossil fuel and renewable and energy improvement was about the same. Today, it's 50 to 60% higher in renewable power and energy efficiency. And that's just exploding now. And we are sitting in the middle of this, this trend. And the same goes for the digital transition. We are investing in data centers for the hyperscalers, and we cannot keep up with the need. And this is because there is a structural growth in specific infrastructure themes, which are now created by these four reasons that I just mentioned to you. So we go to the next page. So it's a very, very favorable outlook underpinned by a number of strong underlying themes. In order to reach the targets by 2030, we need to double our investments in renewable energy and energy efficiency. We need to add billions or trillions to follow the investment we need when it comes to the support the energy transition with digital tools. And EQT is now sitting as one of the leading investors in the world with a deal flow which is second to none. We can't rely on the public sector to just continue to increase taxes and increase their borrowing. And we on the private sector are normally more efficient in investing and managing these opportunities. So what has EQT done in this space now? Yeah, the infrastructure space holds unique opportunity, mainly within the energy transition. So the energy transition is driving demand for further accelerate the SWIFT that I talked about. We are talking about a trend which we have never seen before. The decarbonization, the decentralization, and the electrification on the energy side. When it comes to resource efficiency, in order to build all these EV cars and charging stations around the world, we need to think about how we use lithium, copper, cobalt, and nickel. So we need to think about resource efficiency, the circular economy. We need to do substantial investments in automation, connectivity, accessibility. And when it comes to the whole digital revolution, global data usage and cloud adoption needs enormous investments. So what keeps all of this together is that these trends are universal, they are significant, they are very much front-loaded. It's uneven distributed around the world, but it's rich of opportunities. We now at EQT Infrastructure, with our presence in Europe, North America, and Asia Pacific, we have a deal flow which is second to none right now. We have to say no to a majority of very, very good opportunities to invest in these companies, these opportunities. So what have we done at EQT when it comes to focus on these sectors? Yeah, we have built a thematic investment organization focusing on four thematic industries. We do digital, we do energy, environmental, transport, logistic, and social infrastructure. So all our investment professionals around the world are divided into one of these sectors. And around the sectors, we are deploying the best operators, industrialists that we have out there in the world to help and support us to focus on themes and sub-themes for each and every region. And we have done substantial investments over the years in all these thematic industries. So you can see here on this slide, under digital, we are focusing on fast and reliable connectivity, Internet of Things, network sharing, cloud adoption. When it comes to energy and environmental, we have bought companies that focus on resource efficiency, the circular economy, and the energy transition. In transport and logistics, sustainable supply chains, etc., etc. And we have also done exemplary, very, very good with our investments. So if you take in, for instance, energy and energy efficiency, we have over the years bought 19 companies in this sector. We have deployed about 22 billion euros. We have grown the EBITDA with more than 50%, and we have realized more than 3 times the money invested. So we have a deep expertise in one of the strongest trends out there in the world right now. If we go to the next slide. So we see growing and operational improvement opportunities in infrastructures, all around the world. And if we take, I'll give you a couple of examples in the sectors we just talked about on the previous slide. When it comes to energy and environmental, we own SolarPack in Europe. We are now rolling out solar energy production in the form of solar panels around Europe in SolarPack. We are doing this and signing long-term agreements with our clients, and the need is just staggering. When it comes to digital, our company EdgeConnect is active in North America, Europe, and in Asia Pacific. We do this for the hyperscalers, the Microsoft, etc. And the pressure on us, the request to just continue to roll out and build these data centers are just enormous. So we are growing these double digits all over the world. When it comes to transport and logistics, we bought the company First Student in the US. We own close to 50,000 yellow buses transporting students to schools in the US. We have a main objective to electrify those buses, and we get strong support from the US government with the IRA Act, where we can apply for subsidies and grants to electrify those buses. And you can just think about when we are coming with our electric buses to the school authorities around the US, compared with our competitors who are still running on diesel, who do you think they will prefer? And then with Evidia, it's our cancer, cancer clinics around Europe. We are providing, essential service to society by consolidating all these cancer clinics and using the data. We have more data than anyone else, and we try to consolidate the analysis of those data. So in our portfolio, despite everyone says 2023 was a difficult year, we grown top line with 12% and EBITDA with more than 16%. We have 5 gigawatt of renewable energy in which we're operating now with another 13 gigawatt in the pipeline. We provide connectivity for 360,000 kilometers of fiber network. And we're transporting 30 million passengers, and 40 million people are using our social services around the globe. So we are a major player in this, and we have provided fantastic returns to our clients over the last 16 years. If we go to the next slide, please. So what's the secret sauce here? Yeah, I think one of the secret sources is that when you are in the infrastructure business, you provide an essential service to the local communities. It's important that you are local, that you're not flying in people and say, hey, trust me, you believe me. When you're buying, for instance, a service providing transportation of your children to schools. So the fact is that we are local in some 25 countries around the world with EQT, and with EQT Infra in some 15 countries. And then we have all the Wallenberg portfolio companies also, which are sister companies, which we rely upon. So local with locals is important to build credibility in those relationships. We have more than 130 investment professionals. The partner group, which you see here, has been with us for the last 20 years plus. And we are in 15 offices, and a mixture of nationality, 23 different nationalities on 4 different continents. So with our sector teams and being local, we have built deep knowledge locally and from an industrial point of view. And here you see, the partner group on this slide here. And as I said, 20 plus is the average years of experience in this group. On the next slide, it follows up with, the investment professionals on the various continents. You can see we have a big group in Europe, and we are on the ground in the most critical countries in Europe. We have a big group on the ground in North America, and we are expanding now to people on the ground in the Asia Pacific region, where we also start seeing more and more of very interesting opportunities. Let's go to the next one and talk a little bit about how we source our transactions. And this is quite interesting. By being local, we use our local relationships to talk to people, the owners of these infrastructure companies locally. We use our industrial advisors to help us open doors. And then in our sector team, we do the sourcing. So in the sector team, we try to identify the most interesting sectors and subsectors in the specific regions. And then we leverage our industrial network, these 600 ex-CEOs, which are working with us, in order to identify the most interesting opportunities. And then we go out and talk to people, the owners and the management teams. And it's a very systematic investment due diligence process. And it's super selective. So in the last couple of years, we have reviewed some, the first needle eye, or, it's called New Development Committee. We have reviewed about 650, close to 650 opportunities. Out of those, we have activated only 160. So majority we have said no to. Final offers we have submitted in about 65 cases. We have done 28 platform investments. That means we have already bought a platform, and then we do 31 add-ons to that platform in order to grow this opportunity. And it's quite interesting because part of our philosophy is to try to find a business which we can scale up. So we find the platform, we pay the price for the platform because we have a scale up, a growth agenda. And then we do add-ons for a much lower multiple than the platform investments. 36 of the 52 deals we have done has been sourced outside a broad auction. And 32 out of the 52 are primary deals across our platform. So that says a little bit about the great opportunity that we see in this infrastructure space. So let's continue to talk about one of the other secret sources in our successful operation, and that is our industrial network. We have 600 ex-CEOs and senior managers, which are divided into our various sector teams across EQT. About 70 of those comes from, we work with us in the infrastructure sectors. These are ex-CEOs of energy, transportation companies, telecom companies, cancer clinics, etc. And they help us from the strategy to sourcing. And then when we do due diligence, we bring these people in to help and support us in due diligence. They are reading all the reports, they go to management presentations. And once we decide to do an acquisition, they join our non-executive board and they invest their own money into the portfolio companies. So it's a very, very important cornerstone in our whole governance of these companies. And here you can see a couple of these people from the various strategies and sectors that we have. Mike Tobin is now the chairman of EdgeConnect, our large data center company. It's one of the larger data centers for the hyperscalers. And he's super well connected in this industry. He helped to unlock multiple add-on opportunities, which we have done. And he is a former CEO of a leading European data center business. So he came in with a relevant background. Another of our advisors is Walter Schmidt. He has been the chairman of two of our portfolio companies, GTEC, which was a distributed energy company in Europe, which it took basically from a German family and then expanded and developed it into a European leading energy company, distributed energy company, and we sold it for close to 5 times the money, 5x. He was also the chairman of when we are rolling out fiber optic in Germany, in the rural area of Germany. He has a very strong reputation and personal network, and he actively contributing to building a strong management team, culture, and transforming this company, GTEC, to a leading enabler of net zero energy solutions. In the transport and logistics sector, we use Michael Moore, significant experience in the running ports and container terminals. We bought part of Los Angeles, Long Beach, one of the largest, world's largest, terminals. We transformed that into a modern, extremely efficient terminal, and then we sold it to one of the leading, container operators in the world. And Michael Moore was the chairman of this company for a couple of years and helped us in that value creation. So these are a couple of examples how we use these industrial advisors. And then let's move to our institutionalized value creation playbook, because what we do is very, very institutionalized. We have been working for 30 years now, and I would say that our operational model sticks up to any one of the best managed companies in the world. So let's talk about the governance first. Our governance is based upon an industrial chairman runs our board. And then we have a sustainability champion also on the board. We make sure that majority of the board are not investment professionals, but they are industrialists, senior executive with profound and deep knowledge about the company, its business, and how to take this company to its full potential. And we require these industrialists to put in a substantial amount of their own wealth into the portfolio companies. When we're coming in, taking over a company, we create something called a troika. The chairman is new to the CEO is new to the chairman on EQT, and EQT is new to the chairman and the CEO. So we create an informal discussion body where we try to meet and talk over the telephone on a weekly basis to empower the CEO. So he feels confident that he has the board and the owner behind him to drive the full potential. Another piece of our institutional value creation is the concept of full potential and de-risking. So we have developed a institutional way of handing over to the management when we take over, a concept around full potential. And we give them access to McKinsey or Bain or someone to help them. So we are coming in with our plans, they develop their full potential plan, and then we merge these two plans to be the business plan for the next couple of years. And we ask management to invest their own money into that combined business plan. We have also a line for line, very detailed operational concept called the House of Value Creation, where we follow up on a regular basis the performance on a line by line of the portfolio company. Over the years, we have developed our own financing team where we leverage the relationship with banks globally from all our portfolio companies. 8-9 years ago, we hired 30 persons to lead our digital team, and we parachute these people into our portfolio companies, to all these infrastructure companies, to help them identify disruptive technologies, use technology to stay ahead of the curve, and to protect them against cyber attacks. And we have also now developed our own artificial intelligence tool. We have 25 computer engineers, and it's called MatterBrain, and we use MatterBrain now to source opportunities, source add-ons, and source the best people. And when it comes to sustainability, we think sustainability is actually value creative. So we have a strong focus on sustainability when we buy a company, and we measure it in the form of KPI improvements on a yearly basis. If we go to the next slide, please. So why should you go buy infrastructure company and invest in infrastructure companies today? Yeah, you buy companies in an oligopolistic and sometimes, a monopolistic position with strong downside protection. These companies have a tendency of not going bankrupt because they provide essential services, connectivity, electricity, water. And if you buy a software company, for instance, software you can be without for a while, but it's essential services like we provide, you can't be without. And then in addition to that, due to our relationship with our clients, we are also inflation protected. So we have gone through our portfolio of all our portfolio companies, and we are 90% protected against inflation because people are willing to pay for these services and pay what we require. And in the relationship, the contract, etc., we often have this kind of inflation protection. The financing market is also strongly supporting of this kind of investments because it contains normally lower risks. And we have been able to finance these companies very, very strongly, and also extended maturity. So 98% of our 52 billion of debt to our portfolio companies are not maturing until after 2026. So a very, very strong support from the financial markets. And then let's talk a little bit, how does EQT create value? Yeah, as I said, we have sold 22 of our 51 portfolio companies we have acquired over the last 16 years at an average MOIC of 2 times the money and 17% net IRR by buying, defensive downside protected companies. How have we do that? What's the secret source of this value creation? About 55, close to 60% lies in our ability to grow and institute operational excellence, because many times these infrastructure companies are a little bit sleepy. And especially if we buy them from municipalities or if they are division of big industrial companies, etc. And then another 55% comes from repositioning and de-risking them. What do I mean by repositioning, de-risking? Yeah, we are extending the contracts. We have better counterparties. We are, niching this company into a sector where they have a higher multiple. We get the higher multiple at exits because they have a little bit a different profile and are less risky but growing more. So we have been able to get a market re-rating, a revenue diversification, renewed contracts, longer term contracts, cash flow protection, etc. And that has helped and support the higher multiple when we're exiting these companies. So now I was thinking about potentially to round off by, if you go to the next slide. So I think by investing in EQT Infrastructure is one of the leading investors in the world and a thought leader. You can invest in value-add infrastructure, which is well positioned in an inflationary and quite volatile environment. We focus on companies with strong proven downside protection, and you get a highly differentiated industrial value creation model, which has demonstrated strong returns across the cycles, as I told you, 2.5 times the money and 17% net IRR. And if you go to the next slide, we have done some 7 different investments already in this Fund 6. So we are about 35% invested. So you're more or less buying into a secondary here now. So I will shortly go through those companies with you. It's 6 companies which we have underwritten somewhere between 15 and 20% IRRs. And historically, we have always under-promised and over-delivered because we take a very, very conservative view in our base case. And then we also do a very strong downside case, where we're even more conservatives. And I can tell you in the last 2 funds, the conservative case returned between 1 and 1.4 times the money. So your capital was always protected in our worst downside cases. So let me go through the companies that you buy into, that you get if you invest with EQT Infrastructure. If you take the next slide, Madison Energy is a US company, which is a developer, owner and operator of distributed solar and energy storage in the US. So we produce the energy locally next to the users and we storage it also. The benefit of that is that you're not so dependent on the transmission systems. And transmission systems, if the sun is not shining, if the wind is not blowing, can be very volatile. And here you avoid a lot of the issues related to that. So this is an attractive, fast-growing renewable distribution generation platform with focus on solar and storage. And we have about, I think it's about 200, 250 projects we are pursuing right now here, with an average length of 22 years with this company, and it's growing very, very nicely. So we go to the next one, so we get some time at the end also to talk, open up for some questions. SK Shieldus is headquartered in South Korea. It's a scale integrated security operator providing physical and cybersecurity with digital security infrastructure against, servicing some 680,000 commercial customer sites in South Korea. And the investment rationale is that we owned a similar company in Europe a couple of years ago, which we grown substantially. And we took the manager who grown that company into the board of this Korean company. The next one, please. Laser Logistic is headquartered in Atlanta, Georgia. Is a provider of outsourced yard management services in North America, primarily moving trailers within and between warehouse yards. It has a 15% share of the outsourced spotting nature in the market. The next one, I see we're getting a lot of questions in here, so I want to get the opportunity to answer those also. So perhaps we can. Do you think it's time now to stop here and start, answering some questions, perhaps?
Sure, yes. We received quite a bit of questions in the chat box. And thank you so much, Leonard, for the insight on the strategy. You have certainly made infrastructure more exciting, no longer sleepy with EQT. So I thought because we have you, the top brain over here. So you have been in the industry for so long. So you must be passionate about infrastructure. So what excites you most about the infrastructure space right now?
Yeah, for me, I ask myself, if you can get mid-teen returns, by buying companies in some kind of oligopolistic position, either it's through contracts, through concession, but more often just because it's the only one. When we roll out fiber in the rural area of Germany, no one ever builds that. To get 15, 20% returns, with that downside protection, and having the whole energy tailwind of energy transition and digitalization of the world behind you, why should you take more risk to get a couple of percentage more? So I think the allocation to infrastructure and this value-add infrastructure should be a substantial part of any portfolio.
Thanks so much.
Yeah.
Yeah, you talk about the downside protection, but there's also investors on the other side of the camp. There's higher for longer interest rates. So what are the implications then in terms of debt financing for your portfolio companies? Don't they require debt financing?
They do, but with our model, we have about 50% in average leverage. And for me, interest rates are not very high, historically. We are, when I started, in this business in Sweden, interest rate was 16%, now it's probably, Europe 3-4%. So the good thing with this is that you have a pass-through of inflation and cost to your clients. So your clients picks up most of that, and that keeps your returns, stable. And with the growth potential and efficiency potential, that compensate more than enough of this interest rate increase. Because if you have the 12-13% top line growth, as I told you, 15-16% EBITDA growth, despite the fact that the interest rates gone up a little bit, that's the good thing with this. You're protected against increased cost in this business.
So okay, I got it. So you don't rely on leverage to generate returns?
No, not at all.
Okay, not at all. Sure.
No.
One more question. It's really, investors like yourself is also in for the money. So what is the exit strategy for the investments? You talk about a different portfolio companies. You exited quite a bit. Probably can you elaborate a bit about the exit strategy again?
Yeah. I mean, our holding period has historically been way too short. It's been 4 or 5 years only. And then we have done our value creation plans, and then we have exited. Many of these companies continue to grow nicely. So you can ask yourself, why don't we hold on to them a little bit longer, since we are continuing to get good returns and good growth. But historically, we have sold to once we have de-risked these companies, we have sold to institutions with low cost of capital, either other core so-called infrastructure funds who are more, sitting, because we have done the heavy lifting here, the operational improvement, and other infrastructure funds doesn't have that kind of capabilities. So they are more there to manage the assets. So we have sold to other more core infrastructure funds, to institutional investors who would like to sit and own these pension funds, insurance companies who want to hold on to these assets for a longer time. And just think about it. Once we've done the capex investment, once we rolled out or built out the infrastructure, they start throwing off a lot of cash yield. And that fits, institutional investors. So there are many different avenues to exit these.
Thank you so much, Lennart, on this one. So you spoke about, the last part I caught you talk about cash yield. So for this EQT Infrastructure VI, do investors expect some cash yield?
No, we have a private equity model here. So we are driving value creation, and we are capital gain focused. And we feel, that if there are excess cash, which we see generated in these companies, we should use them for further improve the operations and the value of the companies. So this strategy is not focused on cash yield.
Yeah, sure. No problem. So no cash yield, but high exit multiple over there. So there's one more question, mostly about exit. So how does EQT demonstrate the alignment of interest with investors?
Yeah, we do it in the following way. First of all, the carry system at EQT goes the full way down to associate, and everyone must take out their part of the GP commit related to the carry. So then we have a European style of carry, so no one sees any money coming back until the investors got all the money, the money invested, preferred return and cost coverage. My investment professional, when we do a deal, they don't get the bonus. They get a capital call from the bank to put in to the carry system. So they are heavily indebted until you got your way after you investors got all your money back. Then we have the board, the non-executive boards of the portfolio companies. They are all investing a substantial amount of their wealth into the portfolio companies. They don't see money coming back until they deliver to you. The management team are investing in the management participation program, a meaningful amount of money. So they don't see money coming back until they deliver the return to you. So this is all integrated in alignment of interest. That's a core cornerstone in EQT's business model. Everyone is dependent on delivering returns before they see capital coming back to them.
Thank you, Lena, on this one. One more question. It's really, this is coming from the perspective of the companies. Why do these companies choose to partner with EQT?
They choose to partner with EQT, first of all, because we have the deep industrial competence to develop and grow the companies and taking them to the next level. We have the capital and we have the best operators in the world. So when we are coming to the owners, many times the owners stay in with a minority position or roll part of the proceeds into the portfolio company and see how we can participate in our value creation. I can give you an example. One of E.ON's largest industrial company, energy company, E.ON, sold all their waste to energy plants. I think it was 19 plants to EQT in Germany, in Benelux, because they couldn't create additional value to them. EQT came in and consolidated them, put the best operators from the best companies on the board of management, and developed it and sold it for close to 5 times the money a couple of years later. So we actually had more competence, industrial competence, than E.ON, and E.ON decided to sell to EQT but stay in with 30%. So they could, this was the core of their business, but we could, develop the company in a better way than they could.
Sure, no problem. Some more, quite a bit of questions. Maybe talk about, will this fund be allowed to take NAV financing and have the previous infrastructure funds take NAV financing for distribution?
Have we taken any refinance? Yeah, we have done it in one case, I think 1 or 2 at most. We did it in a company called Kodiak, which we listed on the stock exchange in the US mid last year. And I think it's been one of the best IPOs. It's up 45-46% since we listed it. It's one of the largest owners of compressor machines for the gas business in the Permian Basin in the US. Yeah. So we took out, we refinanced it and took out basically what we did was we repaid part of the capital.
Thank you so much. I think this is an important question. I thought, how do you manage the rising geopolitical risk and currency risk? So what are the key factors that you win projects over competitors, if not price?
Yeah, we try to stay out of geopolitical tension, and this is a very domestic, because it's a good thing with infrastructure. It's a very domestic business. It's an oligopolistic domestic business. So we own, 70-75% in certain areas of waste to energy in the US. Doesn't matter what US have a relationship with China when you own a domestic, waste to energy or energy renewable company in Spain or in the US, etc. It's not cross-border businesses. These businesses normally often provides local services, and essential services. That answers the geopolitical thing. What else was it? Yes, I forgot the rest of your question.
It's about the currency risk.
Yeah, you can choose 2 sleeves here. we know our investments are mainly in Europe and North America, so it's mainly euro and US dollar, and we don't hedge the equity, but you can choose which sleeve if we want to invest in our euro sleeve or our US dollar sleeve, I guess.
I think for DBS, we are actually going via our capital feeder, which is via as a USD.
USD, yeah. And
into the underlying fund.
Yeah.
Okay, no problem.
Yeah.
Okay, so there's one, your net return seems to be higher than your competitor fund.
Yes, it is.
Could you highlight why their return is not at your level?
Yeah, I think
the competitor is actually probably the competitor. I shan't share the name, but it's actually top few in terms of infrastructure investing.
Yeah. I think the secret sauce is that all our competitors are ex-bankers who have started a private equity infra fund. We are coming out of 150 years of industrial tradition from the Wallenbergs, they are still the biggest owners, sit on our boards, and we're using their model, 150 years of experience, industrial value creation experience, and access to these, the best operators in the world. So we have developed that industrial institutional value creation over the last 30 years. So our competitors, since I started this 2007, they can copy everything we do, because we don't have any machineries, we don't have a proprietary technologies, IP right. But one thing is very difficult to copy: our values, our culture, and part of that culture is our industrial heritage.
Lennart, thank you. Thanks for sharing the secret sauce for that. Yeah. I think the other question, we can take a few more. In terms of the geography split again.
Yeah, we probably will invest about 50%, 45% in Europe, 45%, 40% in the US, 10-15% in Asia Pacific, and mainly Asia Pacific, OECD.
So why, maybe out of curiosity, why not Asia Pacific developing? Isn't that more exciting in terms of the growth?
Yeah, it is, but it's more a developing economies, and we are not a developer of infrastructure. We are not a construction. We buy existing companies with strong cash flows, and then we go in with the best operators we can find in the world, and we improve it.
Yeah, sure. Thank you. Thanks, Lennart. That answers the question. I think the other question is really coming from our investors' perspective. So typically, when does the infrastructure fund start exiting?
Normally 4 to 5 years after acquisition has been our historical holding periods.
Okay, 4 to 5 years for historical holding period.
Yeah, historically that's been. Yeah.
Okay. Okay. There's maybe we take one more question. Is really, you touch on the carry interest, which is a hybrid model, European plus American waterfall, that 10% thereabout. Yeah. So there's a question on the carry interest on the preferred return. Why is the hurdle rate so low?
I'll tell you why it is. It's ridiculous because we have delivered 17% net. But when we started infrastructure 2007, 2008, our private equity guys who was looking for 25% IRR, they had an 8% hurdle. And then I said, we are not looking for 25%. We buy less risky companies. So we're looking for 15% returns, but with strong downside protection. So why shouldn't we have a little bit lower, preferred? So, and it's just been hanging in there since then. We have never had a company which we have, had a pursued with a 6%, IRR.
Just building on the earlier question that I was asking in terms of, because we are an Asian bank as well, DBS has roots in Asia. So there's one question whether, would there be any China-related assets that the fund is planning to buy?
No. China is not focused on this. What we have done is in one of our portfolio companies, EdgeConnect, we have been doing a couple of data centers in China in a joint venture, and that is because the hyperscalers wanted us to, build a data center in China. But otherwise, China is not the focus of this fund.
Yeah, sure. Thank you so much. I think probably, Leonard, if I may give you a few more minutes to really sum up what is the key takeaways from your side on this strategy? Why should investors consider EQT Infrastructure VI?
Yeah. This is the strongest political, tailwind commercial tailwind we have seen since beginning of industrialization. The energy transition, digitalization is the strongest trend. The trend is normally your friend when you invest. EQT is the prime, investor in this space globally. And we have 16 years of history now where we have delivered outstanding returns. So I ask myself, why take additional risks, when you can get mid to high teen returns in this space now? It's once in an opportunity now, because in the next 5 years, we will scale up many of these opportunities that we're investing in now. And the scale up opportunity is second to none. No other business can see that kind of tailwind. So, and you get the full downside protection, inflation protection for this kind of returns. So this is an asset class that will grow substantially. And I think you've also seen that BlackRock bought GIP, and Larry Fink stated that he thinks this is the most interesting asset class for the years to come. I have said that for 15 years, so I'm happy that Larry Fink picked that up now.
Yeah.
Thank you.
Thanks, Leonard. Since we are on the top of the hour, for participants that we haven't answered your question, you can send it across to us or to your RMs. We can have that answer subsequently. Leonard summed it very well. In fact, the key takeaways. So I was about to do that. Of course, supportive macro conditions for infrastructure investing. There are tailwinds from your mega trends. Digitalization is one, and the bigger one is, in fact, energy transition. So, and also during inflationary period, there is resilient performance for infrastructure assets. And Leonard also talked a lot about downside protection. So EQT Infrastructure VI improves the risk and return profile of your portfolio, low correlation to public markets and low volatility. And also the underlying assets are providing essential services. It could be backed by long-term contracts, and it could offer inflation or downside protection for you. And not to mention really the EQT heritage, as well as their deep investment expertise, very strong and compelling track record. EQT Infrastructure funds have delivered around 17% net IRR, 2 times MOIC. And as part of our due diligence, we have done some benchmarking. EQT Infrastructure Fund's performance against other similar private infrastructure funds has been predominantly top quartile. And if you were to compare against public market indices, which we are very familiar with, it has consistently outperformed public market indices. So these are really the key takeaways from this webinar. And of course, we are very honored to have Leonard, a very, very seasoned investment professional with us today. And thank you so much for your time, Leonard, and also to all clients for spending your precious afternoon with us.
Thank you very much for having me.
Thank you so much. Thank you so much, Leonard.
Thank you very much for having me.
Yeah.
All the best. Bye.
Bye-bye. Thank you.